Well, hello everybody, and welcome to this third episode of the second season of Cartagena Talks. We're very happy to having you all with us. And today we're going to talk about ESG in fixed income, and we have a special guest with us, Michael Kashani from Goldman Sachs. He's the global head of ESG portfolio management within GSAM fixed income division. He's also responsible for coordinating ESG integration efforts across all fixed income teams, as well as serving as a lead portfolio manager for ESG enhanced and ESG impact mandates. He also leads the development of GSAM ESG product solutions. And he was previously on GSAM Muni's team, where he worked as a senior research analyst and was instrumental in developing ESG capabilities within the team. Prior to joining Goldman Sachs, Michael worked as a credit analyst at American Capital Access and Standard & Poor's, working primarily within the healthcare and education sectors. So Michael, thanks a lot for accepting our invitation, and welcome.
Thank you for having me, and nice to be here virtually. Hopefully soon we'll be able to travel and be all together.
Soon. Eventually this year, probably the next one. But ESG, right? Definitely one of the main investment themes over the last years. Right, and certainly a topic that appears every time we go to an investment event. But when you talk with the central bank and official institutions community, it is still not very clear how to implement ESG on our portfolios, given the particular characteristics that those have. Right, in a certain way, ESG metrics are kind of thought for equity investments or maybe corporate debt investments. It is very related with companies, and those kind of assets are not heavily owned for on our portfolios of official institutions and reserve managers. So we don't want to do another ESG event. We want to focus on the kind of questions that this small group of reserve managers present at the session and the kind of questions that we all have, right? And is how to implement ESG and these important trends on our portfolios with the special characteristics that we have. Please, to the audience, feel free to ask any question to Michael. We have the Q&A option or the chat available for that. And anytime, if you want to post a question, feel free to do that. We are gonna have a conversation with Michael. We have no slides or any presentation to show. We want this to be as dynamic as it can be, right? So the first question, Michael, again, ESG, something we have been hearing a lot over the last years, but what it means, how it can impact our portfolios, and as asset managers, which are the first steps that we should take in order to start thinking about ESG and the implementation of it in our investment process?
Wonderful, great question, Mario. I think the first thing is we need to define what we're speaking to. And so first of all, every asset manager and really every asset owner needs to think about a philosophy on ESG. Within Goldman Sachs Asset Management, our philosophy is that we are required to integrate material, environmental, social, and governance issues into our investment process, owned by the investment teams with the partnership of ESG dedicated individuals like myself. And the question is, why do we do that? And so you hear a lot about products, or solutions. I'm gonna move those to the side because that is a subset of what maybe the people in the audience and really what the broader market is interested in. First and foremost, what we're always interested is making the best investment decisions. And having more tools in order to make those better investment decisions should be everyone's focus. And so as you noted, my past life as a former research analyst, I focused on distressed credit. Actually, some of my final work as a credit analyst was a Puerto Rico bond restructuring. And so when you look at what are the key issues, whether even outside of corporates, governmental entities, supras and agencies, mortgage-backed securities, it's the focus on material, environmental and social issues, again, owned by the team members who cover those asset classes with dedicated ESG individuals that help enrich that analysis. So first and foremost, this is not about necessarily saving the world, though that could be a nice byproduct. It's about making sure that we're good fiduciaries, that we're protecting the assets that we're entrusted with as an asset manager. When you're selecting asset managers or work with them, you want to make sure there's a robust framework about ESG integration. The second is we, as investors, fixed income asset managers, we have a unique position to encourage positive change in issuer behavior. For far too long, people have thought about engagement as just when you're an equity owner, you can vote your shares. Now, that is a very strong tool for equity. We don't have that in fixed income. What we've developed even before ESG came into prominence were relationships with issuers. And so we have continued to leverage those relationships to now discuss ESG issues. I'd say governance issues were historically discussed. That's not anything particularly new. But now with better data, we can engage, or sometimes the lack of data, we can engage with issuers on material, environmental, and social issues. But you won't know what to engage with until you've done that assessment on what are the key areas of ESG that I should focus on my 30-minute conversation with a CFO. So just as an example. The third is client solutions. We know our clients have different points that they need to achieve. Obviously, returns and capital preservation are a very big focus. But also, we know that some of them need to bring in some ESG factors into the management of their portfolio. There may be some certain, let's say, human rights issues, weapons, there could be environmental issues, there could be social issues, and they may want to reflect those values as an organization within their portfolio. And it is incumbent on us in doing so to provide transparency. So solutions just don't mean products, they also mean clear reporting, the ability to be transparent with their clients. So we give them the information and power to make the best decision.
That's interesting what you mentioned on your background, right? Because you maybe shared some of the concerns that we as investors have. And as I mentioned before, when you think about ESG and the metrics and indicators that I use to develop the ESG models and ESG scores, most of them are thought in maybe to apply them on a company, right? Like what's the carbon print, what's the social impact of that company on its community, what's the corporate governance of it, and then you apply some score to those companies. But when we reserve managers say, okay, let's implement ESG on our portfolios, we don't have that much company exposure on them, given that our equity exposure is pretty low in many of reserve managers, it's actually zero, and corporate debt is also has a low exposure in the whole portfolio. Our main holdings are government issuers and quasi-government issuers, right? And given your background and working on the Munis desk, which share some of those characteristics, how can we apply those ESG principles in this spectrum of investment, government and quasi-government?
Great question, Mario. I think it's an area that's overlooked. It's actually an area that has fantastic data that goes back many years, which is not something we can say for the corporate. So let's leave corporates aside for a minute. Let's talk about sovereigns. We have data from entities like the World Bank, UNDP, that goes back many years. And obviously governance is first and foremost when you think about a sovereign or a quasi-sovereign, without a doubt. However, when we're looking at a sovereign, we're looking at social issues, gender participation in the workforce, inequality of wealth. We're looking at health outcomes. We're looking at education outcomes. And these areas within different sovereigns, so if you think about the scale of developed markets to emerging markets, when you look at some of those social issues, I'll get to environmental in a minute, when you look at those social issues, that's the potential for social unrest. So this isn't a nice to have. This is something we are, again, required to think about when we're thinking about pricing that risk. So areas where outcomes, especially during COVID, we've seen this even materialize even greater, that we need to be focused on these issues. For developed market, that could be a change in political leadership, which can also have implications on taxing, the direction of that developed market sovereign. So these social issues, there's a lot of fantastic data, and I'm going to keep bringing this back to the partnership. Who owns this? It's the sovereign economists. It's the same sovereign economists that have been looking over and evaluating these sovereigns for hopefully many decades. But now they have this dedicated ESG team that brings this wealth of knowledge and partnerships. There's a partnership. And what we like to say is no one with ESG in their title applies an ESG assessment. They are there to facilitate the improvement or the evolution of those sovereign economists to now integrate those issues. So that's on the social side. Environmental, we know that now every sovereign has made commitments alongside the Paris Accords. We know that there are some issuers that are more dependent on fossil fuels. What's that transition going to look like? Issues that we need to be concerned about. Also physical risk. And that's where we have to go outside of what I would say is traditional sources for data, finding those climate scientists that can then tie data to a sovereign security and tell us, is there a risk of flooding? Is there heat risk that can have significant impact on agriculture, which may be a certain sovereign's significant source of GDP? So, these issues, we always say this, it's saving the world is a potential byproduct here. What the real focus here is we can evaluate risk and then allow our sovereign economists to have the data, the tools to engage. There was an engagement with a sovereign and our sovereign economists, and it was because of this data that it led to about a 15-minute of the 30 minutes on the infrastructure that sovereign needed to invest in to mitigate flood risk. And it was actually, the sovereign was very open to speaking about it because it is something that is going to help preserve their economic well-being.
And you talked about data, right? And that it's been there for a long time. Maybe it depends, of course, and it depends on the kind of data you are trying to get, either for a company or a sovereign. And also, I would guess that it depends a lot if it's a developed market or emerging market, right? Here at the region, and given the group that is present, I guess that the availability of ESG metrics for our region sovereigns and also for our companies is at least more limited that the availability compared to the developed market issuers. How shall we deal with that, right? When you face a company or a sovereign issuer where you cannot find that data, that's a negative per se for the issuer, or that's something that is ignored by the model?
Sure, we need to be aware of that. Different regions, I'd say, are more used to and familiar with disclosing data, especially on ESG factors. So it is not a one-size-fits-all approach. And on the corporate side, we obviously see even above the United States, European issuers tend to get, I would say, better ESG scores by some of those third-party providers because they disclose more data. We are still in the education phase of the market, especially as we go into fixed income, where we have issuers that don't issue, that are not in the equity market. They have not been hearing about this need. And so instead of, again, penalizing, it's educating and engaging. Now, if we continue to engage and we see very little response or potentially being ignored, that's going to start to have a negative impact on our assessment. And that's why when we think about our assessments, we rate nearly 3,000 issuers across corporates, investment grade, high yield, emerging market, sovereign, supras, agencies. That's 3,000 our coverage. There's a lot of missing data, and that's why it is important for our analysts to own that process, but then be able to say there's a gap here. That gap is going to be a potential negative. It's not a positive, but let me see what I can do through a dialogue with the issuer. And that doesn't matter if it's a sovereign or if it's even an investment grade credit. It's that dialogue we need to be familiar with. The issuers are starting to be familiar with. The outcomes will take time though. And I think it's understanding that it's the progress. It's not necessarily being focused on just where you are today.
And there with the comparison of issuers, and it's typical for us investors to compare ESG scores and ESG models with the world of rating, credit rating agencies, right? And because there, even if you are do not agree with the rating that they give for a certain issuer, or even if you have your own credit score model, well, it's something that it is implemented on our guidelines, on our investment process, and something very clear, and it allowed us to compare even a sovereign issuer with a corporate issuer or a quasi. If it's investment grade, it's investment grade, right? If it's AAA, it's AAA, and it's pretty simple to do that comparison. In the ESG world, is more difficult, right? And part of the reason is the data availability, and also the other reason is that not every ESG metric applies to every issuer, right? Some of the metrics you mentioned before apply for a sovereign, but do not apply at all for a corporate. So how do you manage the comparison between different issuers, and is a certain score of X equivalent to a certain score of X in a different group set of sovereigns, sectors, and any different kind of issuers you can have in the market?
Sure, great question. So you also noted in my background that I was a credit rating agency analyst as well. So I'm familiar with that comparison. It's not the best comparison. And it's not to say that the ESG ratings from these third-party providers aren't useful. You're right, they are becoming, I would say, comparable by some as a credit rating, meaning it's a third-party opinion. And that's where I'd say the comparison really stops. It is a third-party view that is used by a growing segment of the market to provide some level of uniformity. Because just like other asset managers, I would disagree or agree with S&P or Moody's rating, and our peers might agree or disagree, and that's how we do our job. We agree, disagree, we find opportunities, dislocations, and we invest according to that. Think about these MSCI Sustainalytics ratings very similarly. They are there as an open, transparent view of that entity's ESG rating on an entity, but it's not about their ability to repay their credit. So let's be very clear, this is not a credit rating. It is a rating on their combination of factors that produce an ESG rating. And knowing that is actually increasingly important, as many clients, many funds out there are writing guidelines to these ratings. So being aware of what entities are in the lowest category or headed to the lowest category is potentially going to be a trading event. from our standpoint, you're asking, how do we compare? We've always looked at ESG ratings as a peer comparison. So even within corporates, we're comparing utilities to utilities, banks to banks. And so when you think about portfolio composition, and then same goes for sovereigns. It's very difficult to compare an EM sovereign, right, to a DM sovereign. That really wouldn't be a just way of going about it. But when you have that peer comparison and you're thinking about allocation and you're saying, I am going to be, let's say, for example, someone was underweight utilities. They're still invested in utilities. The question is, what utilities are they going to invest in? They still may be overweight developed market sovereigns. That doesn't tell them which sovereigns that they're going to invest in, or maybe they're underweight emerging market sovereigns. So the ability to not conflate positioning with your ESG views, allow positioning to be positioning, and maybe that is informed by ESG views along with others, but then always thinking about it from a peer comparison and making sure you're compensated for the risks associated with that credit. Because I think this is you brought up fixed income. We are not investing in one security, and we don't have one opinion, even on one name. And so we could have a very different view on how ESG impacts, let's say, an auto manufacturer for bonds that mature within 3 years versus bonds that mature in 30 years. So I just threw another level of complexity that the equity market doesn't even need to think about usually for ESG, which is it's not even one opinion for one specific credit.
You touched 2 points that raised me a couple of questions. The first one, and taking advantage of the comparison, which is made, which is not the best comparison with credit ratings, but taking advantage of that, credit ratings try to answer a very specific question, right? Which is, will this issuer pay me back? Okay, and what's the probability that they will pay me back the money I am lending to them? And they are giving me back an estimation of that probability. Right? What's the question that ESG scores and ESG models are trying to answer?
Great. It's what component of that overall view should be considered alongside an ESG view. So the ESG view is an assessment that is a component of the overall view. But it's very important to extract that. And so you'll probably hear, I'm sure many people who have various asset managers, and they'll say, how long have you been doing ESG? And everyone answers, I've always done ESG. Well, that's partially true, but we're also all evolving. And so the ability to extract a view, I almost look at, if you're looking at an issuer and you said, I'm going to see who has the best balance sheet. You extract that view alongside a peer set. And again, you wouldn't compare a bank's balance sheet to a utilities balance sheet. You'd compare like securities to like securities. And you say, well, this bank has the strongest balance sheet. I still don't like them as an investment, and here's why. And so ESG needs to be taken from a similar perspective, extracting the view, having both qualitative and quantitative inputs into that view. So not only what the institution has done in the past, but really what it's doing going forward. So thinking about momentum, we want these views to be live and actionable. But always that view extracting, and I would say one more point on that. Extracting the view is really important, because if something occurs holistically that one of those views is going to take a higher weight, I'll give the example. Let's say regulations in the US on the E side, on the environmental side. We were able, because we had extracted views on the E rating, our environmental rating, to see which companies were poorly positioned for potential increased regulations with a new administration. So being able to extract that doesn't mean it becomes the only issue you think about. There's so many other issues when we look at a credit, but being able to extract that allows you to note how that looks like along this peer set. And if an issue comes up, we can then extract that view and maybe lean in or lean out for either a short period of time or an extended period of time.
And the other point was related with what you just mentioned, is comparison between different types of issuers. Because most of the times when we have explored the ESG models. Most of them try to rank a group of issuers within their specific sector or within a specific characteristic they share, right? So this is the highest ranking in ESG bank in our score, and this is the lowest ranking bank in our score. This is the highest oil producer in our score, and the lowest, right? And you try to, of course, have a high exposure on the ones which have the highest ranking, but that doesn't mean that this oil export is comparable with this bank, right? Even when they are the best in their group, probably this one should have a lower rating compared to the one that doesn't have a high carbon footprint. So how do you manage that comparison within different issuers, given that you still need some diversification in terms of sectors in your portfolio?
Sure. That's where, again, and it was I brought it up in the beginning that, you know, we say the people who own ESG most are people with ESG with ESG not in their title, not people like me. It's the portfolio manager that covers investment grade corporate credit or a liquidity portfolio, which again would take in credit, sovereigns, supra, sometimes even EM. And they would think about those ESG issues from a positioning perspective, sector positioning, rather than comparing a rating to a rating. So, and when I speak like that, you know, Mario, you're probably saying that, well, that just sounds like portfolio management, and that's because it is. This is what good portfolio management should be. It's almost as if some people have written a different rule set for ESG, and it wasn't intended to be that way. It was intended to be an added lens that allows investors to have more insight, not restricting the universe, but expanding our thought of where there might be credit risk or where there might be opportunity. Additionally, what it allows for, just like a credit rating, and I'm going to go back to the credit rating example, I'm sure yourselves as well as others may really like an asset manager. They may really like the internal rating process, but they still say, but if S&P says it's below a triple B minus, we can't allow the investment in that. And so it's become very similar with ESG data, where no matter what we may think, and we're very understanding of that, there are certain thresholds that institutions want to place, whether it's ratings, whether it's exposure to different environmental issues or exposure to different social or human rights issues. And that's what's evolved. The fundamental ESG integration, our transparency to our investors on their exposures for different ESG issues, the carbon footprint. We were talking about gender diversity on a board level with another client. For corporates, gender participation in the economy. For sovereigns, so there are clients that are using some of these metrics in addition to how we use them to put different ESG objectives within their portfolio. And I say that's the evolution that we've seen. And to me, it's a lot more data. It's maybe the data isn't as great or as plentiful as a credit rating, but it's very similar in the fact of allowing managers to have their best ideas, implementing on the portfolio, but also creating some rule set that gives some, I would say, barriers or some gating around certain ESG issues that the manager can't break through.
And do you think that the market is moving in that right direction in terms of today, when we participate in an auction of some issuer, one of the main components of the characteristics of the issuer is the credit rating, right? See, this issuer is single A by the S&P, triple B by Moody's, and triple B by Fitch as well. And in the future, we will have this plus an ESG score, which also would be a restriction for portfolio managers. And besides the credit rating, it also have a ESG score of 10 by MSCI or maybe by the same rating agencies. Do you think we're moving to that direction, or just the direction that we will still have credit ratings on one side, and then the ESG score appears just as a restriction and a characteristic developed internally by the portfolio management team?
Sure. I think the difference is there will probably be less uniformity on ESG because unlike credit risk, I think we can largely agree on what's credit risk and how we think about credit risk. Also, S&P and Moody's are regulated. So again, gives, I'd say, some level of comfort on that process. However, ESG is very personal to each institution.
Yeah.
And so some institutions like to use the ESG third-party ratings. Other like to use data, raw data. Some want to be inclusive and really invest in more, you could say, impact securities like green bonds, social and sustainability bonds. So the difference here is we have guidelines for, I think we can say this comfortably, hundreds of clients that have and range from retail investors to very large institutional to funds. And I could say with pretty strong confidence, nearly no two guidelines are the same, both in the factors that the combination of the factors they're considering and in the thresholds. One client might say, I don't want to invest in any utility with more than 10% of revenue from thermal coal. Another will say 30%, and the other will say no more than 2%, but if it's a green bond, I'll let it in my portfolio. So you can see how personal this gets. I think that's where it comes to, how do you actually manage to these issues? Because that's actually a really important question. How do you take all this information and make sure, like we always say, how do you make sure this is, again, sound portfolio management and not something separate of just saying, well, this is ESG?
And that's another very important point, because every asset manager, when they try to introduce ESG on their portfolios, they face that question: should I build my own model, or should I get an external ESG score? And when you look for external providers, then the question that arises is they all give different weights to different ESG metrics, right? So which one is best for me? Which one is more aligned with my investment objectives? And then on the other side is, okay, if I try to build it internally, then how and what kind of weight should I give to this kind of metrics? So what would be your two questions there? What would be your recommendation in terms of building internal models versus getting external providers? And the second question is, what are official institutions and your clients doing in this subject?
Sure. The answer is it's a combination. So extremely important, I would say even required, to have your own internal framework and assessment. We'll bring it back to the credit. Just like you would expect us to have our own view on credit, even though we can consume S&P, Moody's, and Fitch ratings, you would expect us to have our own view. So think about it similarly. I say that the addition to the ratings, so getting away from just ratings, are the raw data underneath that. And so it's a combination of the two, because we have clients that are using both. They're using, maybe some are more focused on ratings, others have no interest in ratings. And so when we're thinking about data, we're thinking about it holistically. We're looking at physical risk down to the municipal level in the United States. We're thinking about demographic trends. So you're thinking, again, we're going outside of corporates. We're thinking, if you think about mortgage-backed securities, we're looking into the ability to repay and whether those mortgages are actually going to individuals who really need mortgages. So you think about the United States system of the agency model. Are those actually going where they're intended to go towards? And so I'd say that it's the combination of that data, and now here gets the fun part. How do you bring that data into a place where you can manage it? And I would say is Excel spreadsheets are not your friend in this area, because we don't manage portfolios that way. And really thinking about, how do you take the data from multiple providers, yourselves, I would say third parties who are very reputable and know how to deliver data, but also newcomers to the market who may not be as adept. And how you get all of that in a central location and then able to tie that to a security so your trader knows what they're trading. So when we're building a portfolio and we're getting to the really boring but extremely important guidelines writing, before we buy a security, we know if that's going to, let's say, violate a threshold. And so the tying of that data I had less gray hair before I started to lead that partnership with our technology team. And I call that a partnership because it absolutely needs to be. The technology, the data strategists need to understand how the portfolio managers are going to use that data, because this data is so different. There's gaps, it's new, sometimes it's qualitative, it's quantitative. What do you do with that? It's so in many areas it's new, but that partnership allows for the use of that data in a way, I'm always going to go back to this, constitutes sound portfolio management, rather than, well, this is ESG, so we're going to do it differently. And that was always our intention when we really embarked on this process of big data on ESG, to make sure that we held the same standard for ESG data than we would for any other data that didn't have ESG before you say the word data.
And that leads us to another how-to question, which is, okay, once I have my my ESG scoring model, when we work with external managers, which is our case and is the case of many of the institutions that join the call, when we work with external managers, how do you communicate those rules to your manager, right? Especially in the cases where it's not an objective measure of ESG score, but it's something that you develop internally, right? Negative screening or just a comparison between the ESG score of your benchmark versus your holdings, a minimum ESG rating. What's your experience of that on that?
So we were really surprised about how much our clients were suffering from a lack of transparency into the ESG exposures of their portfolio. I would say that they were largely flying blind. And so we made it a significant commitment on our point to be as transparent as possible, as much as the data providers allow us to, based on the ESG exposures of a portfolio. And then really empowering our clients, who we see as partners, empowering them to ask questions. Why do I own this name that has a very poor ESG rating? Why is my carbon 20% lower? Why is it 20% higher? And being really open and actually excited to have that conversation, because that allows us to, in our view, demonstrate our robust internal process of assessing ESG, but it also allows the client to say, again, I'm just gonna go back to the credit rating. I understand your view, and sometimes they may even agree with our view, but they may also have a commitment for whatever reason to a certain ESG issue. And no matter what the pricing is, they might make a decision and have made decisions. And I'll kind of say it's not just a European discussion anymore. This has moved into the Americas, of what I would say, what ESG commitments they can make without having a material impact on performance. It would be impossible to say that you would set a screen on something and it has no impact on performance. That would be disingenuous. The question is, and again, let's move ESG out of the equation. We work with clients all the time on specific guidelines that they may have that weren't necessarily something we offered, but those were necessary for the client. And we have the conversation all the time and the client might ask, okay, if I institute this rule, is that going to be material to what our original objectives are? And the question is sometimes yes, and sometimes no, but always transparency. ESG did not have that transparency historically because people just didn't have the data and information. And so the first and most important step is that reporting, to be able to give that transparency, and then having that dialogue if there is an ESG commitment that a certain client wants to make, of what potential impact that may have on the portfolio's return objectives.
And following your lead, what impact have you found in terms of return or risk when you implement ESG on those portfolios?
I would say the vast majority of clients are selecting ESG characteristics, both the characteristics themselves and the thresholds, that will not have an impact, a material impact. So because we have that visibility, we can iterate with them. So they can think about a theme, and I'll just give the example of, you probably hear a lot about thermal coal as a very big focus. And so I'll just use that as that example. We had one client that came to us and said, we want to remove any entity with more than 10% of revenue from thermal coal. We did the analysis, we showed them the impact. They came back to us and said, okay, what else can we do? What's the next step? And where we came to was a higher threshold. So they still were creating a threshold. It wasn't as severe as they originally intended, but they still kept the characteristic that they were attempting to achieve. Because what we noted to them is this is a journey. And also you probably also want to give us some flexibility to own that entity that is maybe decarbonizing very quickly. Or if an entity had an unfortunate, I would say, controversy, but is addressing that controversy, giving us the ability to note, we believe this is progressing in a positive way. So what we've seen here are, I would say, a little bit more flexibility than maybe some clients will say, it doesn't matter what the impact is, I need to make these specific requirements. Some do that. I'd say more of this is a relationship and a conversation between ourselves and the asset owner and our clients to say, okay, what's the theme we're interested in? And now let's think of things that are meaningful, but not material to the performance of the portfolio.
Good, good. And before we jump to the audience questions, one last question I have to ask you: what kind of investment solutions you GSAM offer to official institutions and central banks in terms of ESG investing?
Sure. Really, it's the ability to customize is something we've always found as a core strength of ours. But we do have baseline strategies or ESG enhanced strategies that allow, I would say, two core tenets to flow through in a portfolio. The first being inclusive growth. And so thinking about issues that both how the company or the issuer treats its internal constituents, but also its external constituents on a social way, social impact on the community, but also how it treats its workers, worker safety. So thinking about both sides of the spectrum. And the other side is accelerating the climate transition. For corporates, that could be decarbonization or where they are in their net zero commitments. For sovereigns, it could be their commitment to the Paris alignment, or for supras, it could be issuance of green social sustainability bonds as a percentage of their total issuance. So we have clients that go down this entire spectrum to one, just wanting to know that we're integrating ESG soundly and not providing any other, I would say, additional ESG requirements on a portfolio. That would still be the vast majority of our clients. And with that, still wanting reporting, still requiring that transparency. The second cohort, I would say, are, I would say, screens of some level, not on a whole sector necessarily. So they're not throwing out all oil and gas or energy names, but again, using those thresholds of involvement to, in some ways, have a best in class, selecting the entities that perform best on that metric. The two areas of evolution that I would say are really interesting are measuring a portfolio holistically. So you mentioned credit ratings. We think about what's the average credit rating of the portfolio. We can also think about what's the average carbon intensity of the portfolio and where is it versus the benchmark, or where's the board diversity on average of a portfolio versus the benchmark, or any really metric that you can quantify. And so having it relative, not to some, I would say, lofty standard, but to a benchmark. And because when you tie it to that benchmark, as that benchmark changes, you can be nimble and change as well. The last level is a very high threshold would be impact. And that's typically reserved for, I would say, a smaller subset, but growing, where one example of an impact strategy where all of the bonds, or nearly all of the bonds in the portfolio, the use of proceeds can be identified as for a green social or sustainability project, or the bond has a step-up coupon feature based on its ability to meet a sustainability metric. So we have portfolios like that are really trying to achieve impact. They're typically a carve out of a much larger portfolio, but that ability to think about this specific use of proceeds, I'd say excitingly doesn't really exist in equities. It's really a fixed income focus.
Perfect. Very interesting. And let's start with some questions from the audience. The first one we have is from Jose Manuel Marquez from the Central Bank of Spain. And the question is, do you think sovereign green bonds has some logic, or instead we should assess the level of greenness of a sovereign?
So I'd say both. So first and foremost, when we look at an issuer, when we look at an issuance, we always look at the issuer first. Again, this is we're always tie it back to the way we do our analysis anyway. We're always looking at the issuer first. We're always looking at the ESG attributes or qualities of an issuer first and foremost. Second, we are looking at the green issuance for a few reasons. One, we want to see, is there a commitment on the issuer for maybe some maybe proof is in the pudding. Are they actually following up on commitments? Green bonds being an indicator of that. Also, these bonds can potentially trade differently because of the just growing demand for green bonds in portfolios. They can trade differently. And so we do need to assess the greenness of an issuer, because if there's some question to the specific issuance framework, there could be some trading implications on that bond, either in the primary or the secondary. So I would say very much we're looking at both, but first and foremost, we're always thinking about the issuer, because if we have an issuer that is not really, I'm going to say, a focus on environmental, it's in an industry where we believe the environmental issue is a key issue, and they're not really progressing relative to their peers, and they issue one green bond and it's not part of a larger framework, and maybe in the green bond is a bit questionable, that green bond can actually be a detriment, not a positive. So we need to think about not only one issuance, but what does that issuance mean from what that issuer is trying to do for the long term, not just one issuance alone.
Got it. Another question from Eduardo Hoyos at FLAR. Regarding ESG scoring fairness, is there any measure to remove political or ideological bias from the scoring system?
So I don't think there's any desire to put ideological or political leanings. I think we are trying to assess the nature of the investment and what is the risk, or what are the ESG risks inherent in that issuer that can result in a change in credit rating or volatility in that bond. So it's not taking a view on something is right or wrong. It's more taking a view on, does a leaning or a factor within that issuer actually expose us to additional risk? Or we've been talking about risk a lot. There's also opportunity. Are some of the steps being taken by that issuer that may not be in the data, but we may have extracted that through engagement, actually show that it's progressing positively? So it's really there for us to make an assessment on we're going to use the word trajectory or momentum, rather than taking a political or ideological stance.
Here's another interesting question, because it includes that this has two perspectives: the perspective of the issuer and the investor. Well, and there's some entities that are both, like ourselves and many supranationals. They have to think either as a green issuer and as a green investor. And here, Daniel Resk, also from FLAR, asked, in your experience, do investors focus equally on all factors, E, S, and G, or is there any clear preference or emphasis for some of them? And here, the question is, as an issuer, should I focus more on one specific factor, thinking in being more attractive for investors, or you have not seen that kind of differences?
Sure, it's very so in corporates we have we call a materiality matrix, where we have over 70 different maps. And so if you ask us, is ES or G more important, we're going to refer to those maps. When you think about, let's say, sovereigns or supranationals or agencies, governance first and foremost. We want to know that there's a sound governance framework. But I could have answered that same question 5 years ago. Now let's evolve into where we're moving going forward. As we're looking into climate transition, there is definitely a focus on green, without a doubt. That we can all see that, and to focus on, are the projects that are being supported, especially by some of these supranationals, are they sustainable? Are they encouraging that sustainable transition? And we've seen, unfortunately, or you know, with what's going on with COVID, is there's a big focus on social now too, positive social outcomes. And so I'd say that's the evolution. Social got ignored for a little bit. It's not that environmental shouldn't get a focus, but in the last 18 months or so, we've had this significant interest in social. So we think social has gained a lot of momentum right now, because if you don't have positive social outcomes, you could do some very fantastic things on the environmental, but especially if you're thinking about an EM sovereign, that you need that support. So those focuses on how are we driving, one, positive social outcomes internally. You could have a greenest project, but your worker safety rates are extremely poor. Again, you know, what's the net outcome of that? Probably not very positive. And then on a sovereign side, those social outcomes, in our view, are becoming more and more important to stability. So I'd say those two factors tend to wrestle, and depending on certain regions, one can be higher than another. But I don't think you can go, but I would say this as a final, one can never be at the expense of the other. So even if you're looking at environmental, that the social factor needs to be considered along with it. And if you're doing social, you also need to think about the environmental implications as well.
Got it. Got it. Here's another question. Eric Lamarck from EIB. ESG is now a financial risk. What is missing now to be able to price the risk as other ones? And do you expect ESG derivatives being developed in the coming months, or is it too early?
We're already hearing that these are starting out. I think it's never too early when you think about the financial markets. We're always there innovating something new and different. So I'd say we're already seeing some preliminary work on derivatives related to ESG, but still definitely early, and no real consensus into how those should be considered.
Okay, and here a question related with one of the topics we discussed before, which is the development of ESG models internally. And here the question is, what impact is artificial intelligence, big data, Internet of Things, and other technologies having on new breeds of data and analysis capabilities for ESG, right? And also related with what you mentioned before, that the Excel spreadsheets are not the right way to build them. So how is this new whole trend being applied to ESG scoring systems?
Sure, I'd say from a big data, let's think about trading. You know, the ability to see market trading. I know we hear a lot about AI being able to scrape data. There's still some areas that need to evolve there for us to trust that in an investment process. But big data from a trading perspective, being able to see across the curve where green bonds are trading, and maybe even picking out a bond that has green features. And because it doesn't trade that often, it may have some pricing abnormalities, but it doesn't trade that often because the holders don't want to trade it, not because there isn't a lot of demand for it. So thinking about those issues, being able to create ways to price that, and then when we see that bond, note that the information that we're seeing might not tell the whole story. So we're really interested in the ability to take vast amounts of information on trading data and move, you know, speed is alpha, as our CIO says. So to be able to move on that information, and increasingly ESG is now another element of that. So when we have that data and we know a bond, this happens particularly in the US, which is little less advanced. Sometimes we know a bond is a social or green bond, and the traders may not know that. And so to have that data integrated into our trading platform because those bonds trade very quickly. The ability to move quickly on that, to us, is a unique opportunity.
And let's take advantage of the pandemic or what happened, and compared again. We all know what happened with the credit ratings and the impact that the pandemic had on many issuers. What about ESG? What was the impact of the pandemic in ESG? Has this been positive, negative, neutral? Talking about environment, equality on the workforce, improved governance of institutions. What have you seen in terms of impact on ESG scores, metrics related with the pandemic?
So always good to take a silver lining. Obviously, we know that there was a lot of suffering and a lot of pain inflicted through the pandemic. What we did learn is a focus on workers, a focus on worker safety. I'd say that's one of the themes that we kept hearing through the pandemic is how are workers being treated? How are workers being protected? Inequality. How do we approach inequality? How do we start to draw some solutions? I'm not going to say solve. That would be maybe too ambitious. But how do we think about wealth inequality, racial inequality, gender? I think the view that the recovery needs to be more inclusive as well. The fact that we all benefit when the recovery of economies is inclusive of all different types of demographics. I think that has been an evolution. What was interesting is that the environmental side didn't skip a beat, right? That didn't lose any momentum. If anything, it increased in momentum. And so what we saw as people were in their homes, working at homes, I think people had more time to reflect and felt that coming out of the recovery, maybe also thinking positively we would come out, is what type of institutions did they want to be? What type of commitments did they want to make? And what we saw, rather than freezing, we saw institutions make commitments across the ESG spectrum globally like never before. So from trying to draw a silver lining from a very difficult circumstance, which I know some people are still going through, and we're not through yet, is that we did see a focus on ESG as a way to show that this is not just about doing good, but that this is the thing that many institutions need to do in order to ensure their viability, whether they be a corporate, a sovereign, a supra, for the long term.
And a final question, this one is mine. Thinking in our mandates and the investment objectives that we as reserve managers have, which are safety, liquidity, and return. ESG is not there, right? So how should we include ESG as a fourth investment objective of reserve managers, or is it something that is embedded in those three that we already have?
It's embedded. It doesn't hurt to point out that it should be embedded and to note, because it is evolving area, what you require. I always say, easy for me to come in and speak about ESG. Get the people who don't have ESG in their title to speak to you about ESG. And I think that getting within your investment policy statement, ESG embedded, not necessarily saying you have to have a screen or ESG characteristics that you manage to, but you require certain aspects of the manager, that they have an ESG rating framework, that they have the ability to evidence that framework, that they have reporting, that they have both dedicated ESG individuals, but also those fundamental individuals that own ESG as well. That's what we're seeing most often, even before any writing of screens or portfolio objectives related to ESG are put in, is I would call the ESG integration language, and then that language on transparency and reporting for those issues. That's really, we think, the first step. And then if you feel like your organization or everyone on the line, and first I again wanted to just say thank you for the questions and being able to be here, but if you feel that your organization also needs greater commitments, that can come in alongside of that or at a later time.
Awesome. Michael, time's over. Definitely enjoyed this Q&A format. I hope it was the same for you. And again, thanks a lot for joining us in in this webinar, and hope to see you soon. Maybe personally in other event that we organize.
Thank you very much for having me. I appreciate it.
Goodbye.